things can happen quickly in this world, especially if you get some strong proponents. And Bitcoin jumps back over $100,000, you're going to have a lot of people, who are actually suddenly in favor of it. So it's absolutely an interesting journey that we're going to be on here. And these are the massive tailwinds that people are just ignoring right now. They are not priced into this stock into this asset. They're just not priced into it. And so for those people who have been kind of frustrated and bewildered and surprised by this latest move, well, Bitcoin always has drawdowns and consolidates before it has another, leg up.
While everyone's distracted, Bitcoin is already gearing up for its next major rally. That's the latest insight from James Lavish, chartered financial analyst, finance educator, and managing partner at the Bitcoin Opportunity Fund. Markets don't wait. They move fast. And Bitcoin is no different. One spark, one shift in momentum, and everything can change in an instant. According to Lavish, while most people are still focused on the past, the real catalysts for the next surge are already falling into place, quietly and without fanfare. They're not priced in, not forecasted, and barely even noticed. This isn't hype, it's the calm before the breakout. If you're still recovering from Bitcoin's last big move, brace yourself. The next leg up could come faster than anyone expects. Stick around until the end of the video, where James Lavish breaks down what's coming next for Bitcoin. You won't want to miss it.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
A lot of people get hung up around the gold, demonetization of gold and how Bitcoin is going to take over gold. And they don't really think about much more than just that, maybe, how much they can get as a percentage of the risk assets of the world. And that's how it's been treated. And quite honestly, it's not wrong. It's how it's been. You can see that Bitcoin is, I like to call it the tip of the risk spear. A lot of people have heard me say that before, and it's the first thing that moves when people want to either add or extract from their exposures to risk assets, meaning typically, like high-flying technology stocks or just overall beta in the market. Bitcoin has a beta to that, right? So it really does move like a risk asset, and it has for a while. So what we were saying there is that if you've seen Jesse Meyer's Croesus chart of the global assets, right? The global investable assets. And it's funny because, I used to make that same exact chart and they're pretty similar, slightly different colors, but I talked to him. He's, I'll give you the chart here so you can put up on the screen right now so people can see it. But, basically this chart he's been gracious enough to share with me and say I could use, so I don't have to do it myself anymore. This chart basically shows that you've got these massive swaths of investable assets. And so if you look at it and you think about just gold and where that is right now and where Bitcoin is. So looking at this chart, I'm going to pull it up here for a second. But looking at that world, a universe of investable assets, you've got gold is about 618 trillion. It's closer to getting 18 and moving up towards 20 now. But you've got art, which is about 18 trillion, cars and collectibles. You've got your equities, which are your true risk assets. That's fluctuating around close to 105, 110 now. But real estate of 330 trillion, bonds of 300 trillion, and then you just got your cash money market accounts and whatnot of 120 trillion. So what am I talking about here? Well, you've been seeing a lot of different products come out that are looking to start incorporating Bitcoin as part of collateral for loans and things like that. And you may have heard Andrew Hones talk about the Bit bonds, and he made a presentation recently about Bit bonds, and I actually wrote about it in the Informationist. And it's basically having a portion of whatever treasury capital the Treasury raises by issuing bonds, they take a portion of that and buy Bitcoin with it and augment the returns of the bonds for both the investor and the Treasury. So, but what I'm talking about here is that Bitcoin to this point has just been treated as a risk asset. But as we continue down this path of just reckless spending, and now we'll back up for a second, hit the pause button here, that we have the Doge Commission and Trump and Musk are out there cutting costs dramatically, and they've cut about $200 billion of costs annually so far. That's a lot. It's not enough. The problem is structurally, we don't make enough money to pay for just the outlandish spending that we have. But part of it is, Luke, that it's spending that we can't cut. It's things like interest on the debt, right? Which is over $1 trillion now. It's about $1.2 trillion. And then, Social Security, Medicare, Medicaid, and things like that. Those are liabilities that are signed into legislation. There's only so much you can cut out of that through administration. You're cutting the administrators and the fat. You're cutting out the Social Security checks to people who are 250 years old. But there's not enough in there to cut it back by $1 trillion. So we're going to continue to run deficits. That's just reality. The only way that we are not going to run deficits is if we have inflation, and significant inflation. I'm not talking about 3-4%. I'm talking about a period of 8, 10, 12%, or maybe even more, where you're literally inflating away that debt by allowing for that inflation to create nominal growth in GDP. Now, everybody talks about the AI revolution, right? And how that's going to be great for productivity. Sure, it's going to make people more productive, but it's also going to take away certain jobs. And so the question is, how deflationary is AI? And what kind of levers do the central bankers have to pull in order to continue this charade of expanding the money supply? Because if you have lower GDP and lower prices of goods, well, how do you get rid of all that debt that you've piled up that was at a GDP that was way higher, right? So they have to continue to expand the money supply. There really is no way around it. So this is a long way of saying that because of that, you're going to see, eventually, you're going to see the people who understand Bitcoin and understand it as a true store of value to start to take some of their capital they've allocated just to risk assets, and some of the capital they've already started doing that, but eventually they're going to take some of that capital they've allocated to bonds and real estate, that they're using those as store of value.
Most people still see Bitcoin as a high-risk asset, maybe a hedge against gold or a speculative tech bet. That made sense when it was new, volatile, and untested. But that view is quickly becoming outdated. According to James Lavish, Bitcoin is evolving into something much bigger. As cracks begin to show in the traditional financial system, Bitcoin is quietly making its way into places it's never been before, from collateralized loans to treasury-backed financial products. It's starting to integrate into the very architecture of real capital markets. Trillions of dollars are parked in bonds, real estate, and cash, waiting for a better alternative. And as deficits grow and inflation becomes part of the system, Bitcoin's role shifts from speculative to strategic. Capital will follow. Now, let's head back to James Lavish for more of his insight.
Eventually down the road, I think Bitcoin will offer safe services for borrowing against. But for now, they'll use Bitcoin rather than real estate because, and not all of it, I'm just saying portions of that allocation that is set aside just for store value, right? So people invest in real estate because real estate goes up as the money supply expands. We know that. But why would they choose Bitcoin over it? Because it's super liquid, super easy to transact in. There's no maintenance cost. There's no headache of dealing with tenants or oversight or anything like that. You just put it in Bitcoin, leave it and wait. You just invest it and walk away, So that's really where I think that this world is headed in Bitcoin eventually. We're not there yet. It's going to take some time, and we're going to have to decouple from the risk assets for that to start happening. And we'll have to have a real broad understanding and adoption from institutional investors for that to start, in my opinion. I think that that first step is people seeing it as kind of like, oh, they're adding it to model portfolios. It still kind of reinforces that digital gold narrative. But when they start adding it to portfolios that are not just portfolios with alternative investments, when they start adding it to portfolios that have long-term store of value and, kind of that 60-40 portfolio mix that they may have, well, that starts to change the narrative in my mind. What it does do, though, Luke, is, and that's a really good point you bring up, is that it informs the investors, the managers, investment managers, RIAs, and other managers who are in charge of other people's money. It gives them the green light to start looking at Bitcoin as an allocation as well for themselves, because in two ways. Number one, they can just look at it and say, well, I use the BlackRock model portfolios for my investors, and that's how I allocate to different exposures. And so it's in there. And so I just give the breakdown and allocate that 1% to 3% in those portfolios, just like they say to. Another thing is they could just look at it and say, look, well, BlackRock's doing it. And BlackRock has this IBIT and big ETF, and you can see the holders of that ETF and of the Fidelity FBTC and Bitwises. You can see that the holders there, and you've got some institutions there now. So people are starting to catch on, and it's starting to get to the point where, Luke, you have to start doing research here. If you're an investor, if you're an investment manager, and you haven't done any research on this, and you've just been shutting it off and saying, no, the Wall Street Journal or CNBC says it's bad, that it's just a Ponzi scheme, so I'm not going to look at it. Well, you're doing a disservice to your business and your investors. You're acting against your fiduciary duty. It's up to you to be curious and to look into these things. It's now nearly a $2 trillion asset. It's been $2 trillion and it's come back a little bit. And, and it has overtaken, basically every single asset in the world, but 8 of them. It's a top 10 asset in the entire world. And if I bring this up, and you'll see this also, we'll bring this one up here, Luke. We'll bring up the largest assets in the world, and you've seen this one, this breakdown, this chart. Bitcoin's right now at number 9. It's right behind Saudi Aramco, which is the largest oil and gas, energy company in the world. And it's right behind silver, which it had crested once and it's come back. But what are the assets that are bigger than it? Gold at 20 trillion. Yeah, see, it's $20 trillion now. Apple at 3 trillion, Microsoft, Nvidia, Amazon, Alphabet, all at 2 trillion and change. And then you've got silver, Saudi Aramco, and Bitcoin. Bitcoin's bigger than Facebook. It's bigger than Berkshire Hathaway. No wonder you hear Warren Buffett. It sounds like he's got a thorn in his side on that. Maybe it's hurt his ego a little bit. It's bigger than Eli Lilly, Walmart, JP Morgan. It's bigger than JP Morgan. No wonder you hear Jamie Dimon frustrated about it. This is not going away. It's becoming an allocation for people. They just have to understand it better, and it will decouple. When that happens remains to be seen. But I think that there's 2 big things that have to happen. And one of them is for broad understanding institutionally, investors institutionally understanding it. And then that reallocation of those store of value assets into Bitcoin. And that's going to be, I think, the key.
For years, Bitcoin was dismissed as speculative, risky, a fringe asset sitting outside the realm of serious finance. But that perception is rapidly changing. With firms like BlackRock now integrating Bitcoin into their model portfolios and institutions quietly ramping up exposure, the market is beginning to treat Bitcoin as more than just digital gold. James Lavish points out what truly sets Bitcoin apart this time: its simplicity and efficiency. Unlike real estate or collectibles, Bitcoin requires no maintenance, no middlemen, and no friction. It's highly liquid, easy to secure, and available 24/7, making it a compelling alternative for capital seeking a reliable, long-term store of value. In a world where traditional assets like bonds and real estate are weighed down by inflation and mounting debt, Bitcoin is starting to look like the smarter play. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.